This is Viewpoints by Hennessy, a podcast focused on the latest thinking from the team at Hennessy Funds. My name is Jay Coulter, and for this interview, we're joined by Bill Davis. Bill is a portfolio manager of the Hennessy STNC ESG Large Cap ETF, symbol STNC. We're going to talk about his fund, but we're going to start the conversation having a talk about what's going on in the world of ESG investing today. Bill, thanks for coming on the podcast.
Jay, thanks for having me.
All right. So there is an ongoing debate about the effectiveness and impact of ESG investing on corporate behavior and long-term performance. In your experience, do companies with strong ESG practices generally outperform their peers in the market?
So that's a great question to start with. And the answer is it's not easy to say. And one of the reasons is that just because a company is well managed, and I would say that the whole ESG movement in a way is simply a proxy for finding a well-managed company, that doesn't mean it's necessarily going to outperform a less well-managed company in the short run. So over a long period of time, I think a better managed company is going to navigate through a variety of different cycles, probably in a smoother, more seamless way. But to say that ESG itself leads to outperformance, I don't really buy it. And we've been doing this for over 9 years. And so I don't think you can make that case. I think you can make the case that that the point of the ESG component of portfolio construction is to align the investors' values with the companies that you end up owning. But in doing so, you're essentially saying, well, we're going to have to figure out where we're getting performance through some other part of portfolio construction.
Excellent. So greenwashing, or the practice of portraying investments as eco-friendly, whether they may be or not, has become another hot topic in the ESG space and in the media. How can investors and regulators identify and address these issues around greenwashing?
Yeah. So ultimately, I think investors need to be discerning about what they invest in. That's point number one. And I completely agree with you, Jay. There are probably way too many products in the market that classify themselves as ESG or sustainable. Keep in mind that it doesn't just apply to investment products. It also applies to the companies that these investment products are investing in, right? So, we are investing in members of the S&P 500. Within the S&P 500, there's greenwashing that's taking place. There are companies that are claiming to be farther along towards a decarbonization path, as an example, than they really are. There are companies that are failing to report significant emissions or areas of interest, let's just say, for investors where they don't do well in. So they essentially either bury those in the back of the corporate sustainability report, or more likely they don't put it in at all. And so all of these things are taking place. It's taking place at the company level, at the investment company level. It's taking place at the individual investment product level. And it's an issue throughout. And my view is that look, I think the best regulation is kind of market-based regulation. So I think to some extent, there is a responsibility for investors to understand what they're actually signing up for. But having said that, I do think that the SEC is going to mandate climate risk disclosures on the part of, let's say, S&P 500 companies. I think the SEC is also going to begin to hold investment firms that purport to be sustainable or offering ESG products to standards akin to what is starting to happen in Europe, where there are levels of qualification for these products. It's like you can be an Article 8 or an Article 7, the higher, or an Article 9, the higher the article that you qualify for, the better. And in a sense, it's kind of it's like a good housekeeping seal, if you will, for investors that are looking at products.
That's a great segue into thinking about some of the international issues around ESG, how are international policies and regulations shaping the way ESG is going to play out over the next several years?
So I don't really think it's quite as much about regulations, because if you think about it, there's really no such thing as an international regulation. And I would say there aren't even really international policies. What there is, I think, a coalescence of thinking and, I don't know, shared interests around investing in companies that are ambitiously decarbonizing their business model. I mean, we're kind of talking about all of this like it's only about decarbonization, and I think ESG is more than that. But I would say, to your question, Jay, I think that the single biggest thing that is happening that's relevant to your question is that two NGOs, one based in the US called Ceres, full disclosure, I'm on the board of Ceres. The second, the UN Principles of Responsible Investing, which has essentially been rebranded as the PRI, formed an initiative about 4 or 5 years ago where they identified 166 companies that are responsible for something like 70% of all man-made greenhouse gas emissions. Like that's a massive number, right? And but at the same time, it also scopes the problem, because it essentially means, look, if we can't get these 166 companies to change their behavior, to think about how to reduce scope 3 emissions, to sign up for some international protocols around climate risk disclosure, reporting and things like that, then we don't really have any chance of being successful. And so that initiative has inspired 700 investment companies around the world, representing 69 trillion of investable assets. So in other words, an awful lot of money has come together, and those companies, the 700 companies, are essentially engaging with the 166 large carbon emitters in the form of investor engagement, where they're approaching them in teams, they're having conversations with board members, they're talking to management, they're doing it on a scheduled basis, and it's actually causing big companies to change their behavior. I mean, I think it was 2 summers ago that ExxonMobil faced a challenge from a startup hedge fund called Engine Number One. Engine Number One convinced a lot of big asset managers in the US to essentially delegate their proxies to them, and ultimately replace 3 board members on Exxon's board. And then just yesterday, Exxon announced a much more ambitious decarbonization plan moving forward. Now, companies saying one thing and doing another thing is kind of how like the industry rolls. So it doesn't mean that you can declare victory, but it does mean things are moving in the right direction.
Let's pivot and talk about your fund for a minute. In a recent CNBC interview, I heard you described the process that you use as a quantitative ESG shop. What does that mean?
Well, it means we're an ESG shop, and it means that we're actually a quantitative and systematic in terms of how we build portfolios. I want to be clear, however, that it's very difficult to be purely systematic with ESG data, because number one, it's some of it is interpretive. Not all of it is very timely. A lot of it's inaccurate. And so I would say on the ESG front, while we score companies quantitatively, we have a rules-based approach to ESG factor assembly, which I could go into. And then on the fundamental side, everything we do is purely quantitative. We operate a multi-algorithmic machine learning program that combines long-term models with short-term models with state-based models. And in that particular instance, attempts to identify the 20% of the S&P 500 that is statistically most likely to outperform during the upcoming quarter or 3-month period. I see you smiling. Is that making sense?
Yeah, absolutely. I hadn't heard that term before. Intuitively, I knew putting those two words together what it meant, but I was curious on how you frame that within your process, which that was perfect. Tell me about the people behind the ETF STNC.
So my partner Kyle Balkasoon and I are the co-portfolio managers. We're surrounded by a support team. We have been the PMs on this strategy on the ETF since its inception a little more than 2 years ago. And Kyle and I have worked together for 9 years from a portfolio construction standpoint. So the team has been consistent along the way. We've added to the team as we've grown, but we haven't, nobody's left the team that, had any material relationship to investment management or portfolio construction.
Okay. Now, you alluded to some of what the answer to this next question is, but let's be very specific. What is the portfolio construction process for STNC?
Okay. So the first thing that we do is we identify companies that, relative to their industry group peers, and that's an important thing, I'll come back to that in a second, are doing a better job of managing and mitigating off-balance sheet risks, which are environmental, social, or governance related. And I say up to 24 material risk factors because not every risk factor applies to every company or the industry group that they're a part of. So here's an example. If we're talking about an insurance company, we're not looking at their environmental footprint. But if we're talking about an industrial company, we are. So I would say in certain industry groups, the way in which we think about ESG factors is it's much more around the composition of the board, the independence of the board, the degree to which there's independence between the chairman of the board and the CEO, the management team makeup and diversity, the CEO to average worker compensation ratios, their charitable giving history, what they do to support the communities that they're in, other governance factors. So in sort of softer industry groups, if you will, those are the kinds of things that we're looking at. But when we're talking about a company that has a relationship, more of a relationship to the physical environment, then we are layering in other things as we should. And of course, the hard part in all of this, Jay, is that we have to figure out how to weight each of these factors that we might be scoring a company on. And this is important because companies are both good and bad, right? I mean, there's companies that do good things. There's companies that consistently do good things. There's companies that consistently do bad things. And I mean this in the context of the material risk factors that I alluded to. But generally speaking, they're doing both at the same time. So you take a company like a Tesla, which is very, very good from a carbon standpoint, but they tend to be really bad from a governance and a many other things standpoint, including worker safety, worker rights, that kinds of stuff, those kinds of attributes. However, because 50% of their score, because they're in the automotive products industry group, is derived from their relationship to carbon emissions, they can frequently be eligible to be in our portfolio from an ESG standpoint. So at the end of the day, we're taking the S&P 500 and we are knocking out the worst 50% of the S&P 500. We are also knocking out categorically fossil fuel companies, weapons companies, and tobacco producers. And we score each of those, material risk factors in a quantitative way. And we think that's important. There is one thing that we're doing that is less quantitative, but it's actually super important. And that is, before we do the final top 50, bottom 50 score calculation, we take data feeds from trusted third parties that are frequently nonprofit organizations, but not only. In some cases, they are, corporations. In other cases, they In 2 cases, they're actually sovereign funds. And in any case, what each of them is doing is some deep dive issue specific work. So it might be into illegal logging or palm oil deforestation or factory farming or for-profit prisons or human rights violations. But those real-time data points we think are important because number one, they're real-time. Secondly, they're coming from trusted resources, and we're able to incorporate that into the scoring. And that's basically the ESG component of the process.
A term you used earlier that I'd love to go a little deeper on is the AI machine learning component of this process. What does that look like?
Well, it looks like computer code if you were kind of sitting in my chair. But basically, think of it as a process for automating fundamental analysis. So most portfolio managers are looking at fundamental financial and risk factors, and ultimately making decisions about how to weigh the importance of those factors, and really trying to find something that is a set of factors or individual factors that are determinant of alpha creation. Like that's kind of the idea, right? And so the challenge is that as there's more and more data out there and more investors have access to more data, it's actually a little bit harder to find an edge. And one of the things that we've found is that there is an edge in automating that work. And so with about 22 years of historical filings data and market data, we are able to, as I mentioned previously, we have 3 algorithms. One is looking at very, very long-term data from a company performance standpoint and also from a market performance standpoint and a sector performance standpoint. And that's looking at it over a very long period of time. Then we have another algorithm that is looking at very short-term data. And then we've got a third algorithm that basically goes out and says, find a point in time that is similar to now and tell us what worked during that period of time and what didn't work. And what's interesting is that these factors have a somewhat static relationship in the sense that short-term factors tend to get a very low weight when we weight the results of these algorithms. One of the reasons is that it's just less reliable. I think more recently, there's a lot of what I would call signal flipping. So when a factor is actually working, it doesn't work for a very long period of time. So it makes it less useful of a tool from a construction standpoint. And of course, state-based is interesting because if you can find like states, it's interesting to see what works, and that can yield, I think, it's some interesting perspective. And so ultimately what we're looking to do is identify the top 100 companies out of the S&P 500 that statistically, based on the input from those algorithms, are most likely to outperform over the next 3 months.
And how do you approach risk management in this ETF?
Okay, so keep in mind we have about 200 companies that we like from an ESG standpoint every quarter. We have 100 companies that we like from a fundamental standpoint. Just because we like a company one way or the other doesn't mean that it's in the portfolio. We have to like them. We actually have to have a dual point of view, which is that we like both of them. So essentially, once we have those 2 piles of companies, we push the piles together, and the overlapping securities basically ends up being the candidates for the portfolio. But then, to your point, like then what do you do? Like how do you manage risk with the names you like? And I think, for many portfolio managers, the goal is to look as much like the underlying benchmark as possible. So in other words, what they do is they optimize a portfolio, or, for those listeners who aren't, in portfolio construction business, I mean, essentially optimizing is figuring out how to weight something. So one way to do it is to weight something according to tracking error so that at the end of the day, if you have 8 names that you like that are in the industrial sector, you make those 8 names add up to the actual weighting of the S&P 500 or industrial. So if it's 12%, those 8 names have to add up to 12%. In our particular case, we don't care about tracking error. We care about diversification, and especially meaning creating as much independence in the portfolio as possible between the positions that we own. But secondly, what we're really trying to do is to manage tail risk. So we are trying through our optimization process to buy the names that we like with the least amount of risk to investor performance. And ultimately, that's what determines the weighting of individual positions. So having said all of that, Jay, we do have a couple of guardrails that are important. So for example, maximum position size is always set at 3.5%. There is no minimum position size. So right now in the portfolio, we have names at 60 basis points and we have names at 350 basis points. The second set of guardrails is around sector weight. So our portfolio can't be more than twice, or a sector in our portfolio can't be more than twice that of the underlying benchmark. So again, using industrials, if it's 12% of the S&P, then the most we could be is 24% of the S&P.
So when I looked at the portfolio today in preparation for this interview, it looked like there is a heavy allocation. In fact, the heaviest allocation in the ETF is to healthcare.
Mm-hmm.
What are your thoughts on why the exposure is so heavy to that particular sector?
Yeah, really, really good question. So the answer to that is because healthcare is kind of a squirrely sector of the economy. It's not really one sector. Think about everything that goes into healthcare. It's everything from, retail pharmacies like CVS and Walgreens to biotech companies to drug discovery companies, medical devices, healthcare plans. So there's all these different, even some healthcare technology companies. So one of the reasons why we like healthcare is that especially once you get kind of down cap a little bit, there's just a lot of opportunity to create outperformance in names that are perhaps less followed by analysts or, they're just not in the top 10% of the S&P 500. So I would say, that's one part of the answer. The other part of the answer is that in general, I think healthcare companies and tech companies tend to be pretty dominant within ESG portfolios. So part of that is because they tend to be younger industries. They tend to not have some environmental legacy or many of the environmental legacy problems that industrial companies might have. So in general, we tend to be overweight healthcare, and we do tend, by the way, to be underweight technology. But importantly, however we're investing, whatever our sector exposure is at any given time, we are almost always down capped from the average of the S&P 500, simply because we think that there is more opportunity to generate outperformance as we go down cap a bit.
Yeah, that makes a lot of sense. Bill, let's wrap up with a lightning round. I think this would be a fun thing to do anytime that you come on Viewpoints by Hennessy. And let's set it up like this. I will give you a holding and you give us the ESG case for that holding, and you have to limit your answer to less than 60 seconds. You can take as little time as you want, but not more than 60 seconds. Are you ready?
I'm ready. Let's do it.
All right. Bill, what is the ESG case for General Electric?
Okay, GE. So, two things. One, GE has made a date certain commitment to reduce all carbon emissions, including scope 3 on sold product, which is a pretty big commitment. And now it's also out in time a little bit. It's 2050. But the other, I think, reason is that GE is just so critical to the future of energy. I think 1/3 of all energy generation globally has GE technology in it. And so the fact that you've got a big player that's made a commitment to be more sustainable creates, I think, an important ESG story right there.
What is the ESG case for Trane Technologies?
A bit of the same kind of a story. I mean, relative to their industry group peers, Train has been out in front in terms of making sustainable investments and sustainability commitments. And they did it very early. So I think it's an important part of the culture at Train. And I also think if you just think about decarbonizing the built environment, I mean, Train's going to be right at the center of that. So as more efficient HVAC equipment comes online, they're going to be kind of a major beneficiary of that.
What is the ESG case for Las Vegas Sands?
So that's a good one because not every ESG manager would own a company that actually has exposure to gambling. We, while we do have, hard-coded exclusions like weapons and tobacco and so forth, we have never had a hard-coded exclusion around gambling. And Las Vegas Sands is a very good operator. They're in the top 50%. It's not even close. They're actually pretty far up in their industry group around hotel management. By the way, Marriott is also good in this regard from an ESG standpoint. And I think that they've been very responsible around how they've kind of like navigated the gambling waters. And so we actually think they're a pretty good name.
Lastly, what is the ESG case for Home Depot?
So this is kind of an interesting one because there isn't really a great ESG case at Home Depot. They have to be in the top 50%, and it turns out that they are. So that there's nothing that they do that's exceptionally well. It just happens to be they're in the top 50%. And that's part of our unemotional approach to investing. If you qualify, you're in. If you don't qualify, you're out. Even though there are times when we own things that, speaking personally, I probably wouldn't want to own if I was just if we weren't systematic managers.
Excellent. Bill, I appreciate you taking the time to come on this interview for Viewpoints by Hennessy. Viewers and listeners, to learn more about the funds at Hennessy, please visit HennessyFunds.com. That is HennessyFunds.com.